Good morning, ladies and gentlemen. Welcome to today's virtual non-deal roadshow. My name is Nadine Salonga, virtual event moderator here at Renmark Financial Communications. On behalf of our team, we want to thank everyone in Calgary and surrounding areas for joining us today for the presentation of Silver Crown Royalties, trading on the CBOE under the ticker symbol SCRI and on the OTCQX under the ticker symbol SLCRF. Presenting today is Peter Burris, Founder, Chairman, and Chief Executive Officer. With that being said, I will now hand it over to Peter.
Hello, everybody in Calgary and surrounding area for joining us today on Renmark's VNDR presentation. I'll tell you a little bit about myself before we get going. I'm a mining engineer by background. I spent a number of years at Placer Dome, at Dome Mine in Timmins. Actually just saw a very nice picture of it today on LinkedIn, and I commented on it. I thought it brought back some really nice memories, especially the winter picture. I spent close to 20 years on the sell side. I spent about half a decade on the buy side, and the last 8-9 years of my life I spent in the corporate world in terms of putting companies together, building them, taking them to market, launching them, etc. And Silver Crown is the latest endeavor in that long chain of various experiences that I've had. And every step of the way, I try to learn a little bit more, and that's all culminated in Silver Crown Royalties creation. One of the driving forces behind Silver Crown, obviously beside the name Silver itself, and we are a silver-only royalty company, which is a little bit unique, was the inability for us to source a product in the market that we felt was safe to invest in and was, relatively worry-free. So failing to find one in the market, we decided to create one, and that's what Silver Crown is the result of. Why silver? Silver, first and foremost, in our opinion, is a hedge against currency devaluation. So as the credit market expands, which is something that's been going on for the last 100+ years and continues to do so, the purchasing power of whatever currency that credit is being expanded in, at the epicenter of that is, of course, the US dollar. The more credit there is out there, the less that dollar will buy you. So if you have a real hard asset like silver, like gold, any other precious metal with a monetary property to it, that will protect you, an investor, from a decline in purchasing power. So instead of going into a business, and royalties can be applied on any, not just commodity, but any stream of revenues, like music industries people are quite familiar with, but those are still backed by dollars as opposed to a real physical commodity with monetary properties that has over time maintained its purchasing power. And in fact, what we've been able to demonstrate is a relationship between the credit market's growth, rate of growth, and the devaluation of the US dollar reflected in the precious metals price. This chart may seem a little busy, a little confusing, but what it demonstrates is that the more credit there is out there, the more dollars are leveraged against that credit. The more dollars there are, the same number of goods and services, the prices go up. Not necessarily because they're more expensive, but because the dollar is worth less. On this chart, we also show how that can be used to not necessarily predict, but infer what the metal price, in this case silver, should be based on the rate of credit expansion. So again, the dollar is levered to the credit expansion. We estimate about 30-1. So the more credit there is expanded, the more dollars there are in circulation. The more dollars there are in circulation, the less they purchase. And based on the rate of credit expansion, we can estimate whether or not the prices that reflect this devaluation in terms of gold and silver are overshooting or undershooting a natural devaluation rate, which is about 10% a year right now. We saw a little bit of an overshoot at the end of October, early November, when silver hit over $54 an ounce for the first time, and a little bit of a pullback since. In fact, the natural rate, as it were, implied a buyback in level of 46, and I think we mentioned that somewhere in one of our emails. But bottom line here is that there is a natural undercurrent that shows that the rate of price appreciation because of currency devaluation to silver is a relatively steady number, maybe somewhat increasing in the last 2 decades. But you have this undercurrent where revenues should increase 10% a year, even if the number of ounces that you're being paid on stays the same. And again, this is a demonstration of the purchasing power preservation of silver and gold. Another part that we liked about silver, I'm just going to hint to it right now, is that it's almost an overlooked sector. There's a lot of focus on gold. There's now a little bit more focus on platinum, palladium, but very little focus on silver. There are a number of silver companies out there, producers, but they produce other metals as well, zinc, lead, some gold as well. And generally, when companies want to focus in or mine something, well, silver is a byproduct, meaning it comes out with copper and with all these other metals as a primary source. Maybe 20% of the silver that is produced comes out of what are deemed to be primary silver mines. So because nobody was focusing in on silver, it really left this open void, as it were, that we wanted to focus in on, because not necessarily because it was easier, it isn't, but there was, I would argue, better reception from the various companies that we tried to do deals with, but also less competition from other players in the industry. And what that allowed us to do is to build a portfolio of royalties. We're now at 5, and we continue to add as many as we can, but we continue to grow at roughly 1 every 6 months. And what we want here is diversification, because we've seen individual royalties, not royalty companies, but individual royalties inside a portfolio not perform well and really hurt the company as a result. What we've tried to do is build a portfolio where if one of the royalties doesn't work out, it really doesn't have too much of an overall impact to Silver Crown. Why do we like the royalty business model? I mentioned this in a later slide, perhaps I should reorganize this, but royalties are essentially an upfront payment, which is in dollar terms, for future deliveries or future payments that are linked to the silver price, in our case. Other royalty companies will have gold, copper, other elements. For us, it's just silver. And this chart here shows why we like that business model. Again, cash upfront, deliveries over time, because it tends to generate returns in excess of cost of capital over this cycle. So this chart shows Wheaton Precious Metals, which is now the biggest royalty/streaming company in the world, started just over 20 years ago, and since then has consistently been able to outperform not just the silver price, but producers that are also in the space. So producers obviously have to deal with costs, oil, labor, various types of other things, chemical reagents, etc. Royalty companies, because again, it's just that upfront payment, they just have G&A costs, which are relatively flat no matter the size of the company. So we like this business model. It's a high margin business, and the returns in this case speak for themselves. 25% CAGR from the IPO in 2024. Franco-Nevada, similar story. This is the godfather of royalty companies, came to be in the early 1980s. So really no such low early stage entry point since then. When Wheaton Precious went public, it was already in the hundreds of millions. When Franco-Nevada went public, when it was spun out of Newmont, you can see here that it was acquired by Newmont, but when it spun out of Newmont, it was already $1.5 billion market cap. When Franco-Nevada got started in the early 1980s, its market cap was $15, $20, $30 million. Right now, our market cap coincidentally is 20 million. And what we show here is simply Franco-Nevada's revenue profile compared to our revenue profile, and what we expect to generate next year in terms of revenues is 3.5 million, which coincides with Franco's. But again, this is just a coincidence. It's an illustration. What we're trying to demonstrate is the high earning power of these companies and the relative performance, not just against the sector itself, not just against the metal price, but against other companies as well. And at a 41% CAGR, we can argue that Franco-Nevada, from when it started in 1982 until it was taken over by Newmont in 2002, that's got to be one of the best portfolio managers out there. We included this slide because Buffett's been in the news recently. He stopped writing his missives that were included in the annual reports that he used to write for a very long time. And I wanted to focus on two things here. Economic moat. This is essentially a checklist that Buffett would use under the tutelage of Graham and Dodd and value investing. But an economic moat is basically, is the product unique? Does it have competitive advantage? Is it a first mover? These sorts of things apply to his economic moat criteria. And I would argue that Silver Crown has all of those things. We're a first mover in the silver royalty space for the time being because it's such a small esoteric part of the mining industry. There's been very little interest in it from other companies. As well, when it comes to growing the company, we can now look at beyond the mining space. So we're going into sectors which royalty companies have in general not considered. We're not going as far as the music industry, there's no silver there, but in terms of industrial production, for instance, if you were to have a recycling facility that recycles post-consumer electronic waste, there's quite a bit of silver there. And very few royalty companies would be talking to them. And if they were, they'd be talking to them about the gold or the platinum or copper or the more dominant metals that would be in that mix. So we believe that Silver Crown has the economic moat. Free cash flow, that is something that was very important to Buffett, looking at discounted future free cash flows, going into net asset values, etc. Well, we don't have free cash flow just yet, but as of 2 months ago, financing that we closed in early October, we are now fully funded to free cash flow. And I believe that this is something that's being missed in the market. And that's where this margin of safety comes in, and that's essentially valuation. Buffett didn't want anybody to overpay for a stock or for a company, even if he thought it ticked all the boxes, everything was great. Well, valuation was very important. If you're buying it at the top of the valuation metrics, it's very difficult to get additional value. Well, we'll make the argument that we are right now trading at the bottom of not just our own historic metrics, but relative to peers in the industry, relative to other royalty companies which are in the precious metal space. And we think that we're trading between 2 and 3 times the valuation where we ultimately could reach when we get to the free cash flow positive number. We would expect sometime Q2, Q3 next year. I mentioned about the concept. Royalty companies, again, they put money up front for production that comes out of a mining operator. I also mentioned that we do cross a little bit over into other types of royalty sources, not just mining industry, but also infrastructure, meaning smelters, refineries, recyclers, off-takers, etc. And another part of the moat, the uniqueness or different approach, we incorporate incentives as well into our royalties, and we incorporate minimum payments, meaning that the vendor, the producer, the operator promises to pay us a certain number of ounces over a certain time frame, or a percentage of production, whichever is higher. And this is a little bit unique in the royalty space. Most royalties exist as options. They simply put the money up front, and then hopefully it comes back from mine production in the future and it grows as the project expands. For us, we aim to look at them more as individual business units, where with the cash up front, we now have a delivery schedule that essentially says over this time frame, this many ounces will come back to us. With this in mind, we've been able to put together 5 different royalties that we now have on the books. And because we're underwriting all of our own royalties, and again, slight differentiation here, most other royalty companies that are under $1 billion market cap, they trade royalties that already exist, or they take royalties out of someone else's portfolio, and they don't necessarily, generally speaking, create their own royalties. There's a few exceptions, of course, but mostly companies under 1 billion market cap simply trade or buy portfolios that already exist. Because we don't do that, there's no competition really in creating these, and it really comes down to agreeing with the producer on what the terms are. And that's why we're able to achieve relatively competitive internal rates of returns on a project-by-project basis, averaging about 26%. Now, these numbers are being calculated based on trailing prices at the time of the agreement, so not trailing 12-month prices from today. If we were to use that, which is about $37 silver, this 26% would be closer to 40%. But we don't do that. Obviously, when we establish the royalty, we use trailing 12-month prices. In terms of growth, how many more royalties can we add? Again, we want that portfolio to be robust. We don't want to be in any way derailed by underperformance in one royalty or 2 or 3. So we need a portfolio of many assets. Well, there are 2,400 operating mines right now that that we're aware of that produce silver in some capacity as well. Most of them as byproduct, some of them unreported. There's exploration projects as well, but we're focusing on cash flow. We want to pay a dividend. We want this company to be a yield product. So exploration, that's great. That's something for 10, 20 years down the road that would add to actual free cash flow bottom line. But we focus on the operators. There are countless recycling facilities, reprocessing facilities. We're starting to talk to them. We're starting to get some transactions completed there. Again, there are countless numbers of these, and very few, if any, other companies are talking to them that we're aware of. So our pipeline at any given point has more than 10 projects in it. We're close to some, a bit further away on others. A majority of that are producing today. So these could be catalytic in terms of adding value very soon, as opposed to when we do get into that free cash flow position. In fact, any one of the transactions that we're in touch with right now could put us into a free cash flow position as soon as that transaction was executed. We've averaged 2 royalties per year, so roughly 1 every 6 months. We've been around 3 years. We have 5 royalties, so it stands to reason that something could be coming. Generally, we focus in on tier 1, tier 2 jurisdictions. We haven't done anything in Africa. Now, that doesn't mean that we won't in the future, but again, the focus is on free cash flow. We want that freedom. We want that independence. We don't want to be beholden by the market for additional equity issue, especially when we think that our equity price is very low right now. We certainly wouldn't want to do another equity issue here. So until we get to free cash flow, we will stick to safe jurisdictions and funding additional growth with cash that we have on the balance sheet. We also have silver on the balance sheet to protect some of that cash for the various reasons discussed earlier. And we will also utilize our equity, but at higher share prices than what's in the market right now. In fact, one of the transactions that we've done, we did a $10 per share of Silver Crown, even though we were trading around 7, so a nice premium. And this is what we can do with our equity in terms of these private transactions that we do with the operator. We don't have to go to the public market to raise at this price if we choose not to. This shows our performance as market capitalization of the company divided by the price of silver. So I showed earlier share price of Wheaton Precious Metals, a royalty company, divided by the price of silver. But that was just the share price, not the market capitalization. This includes additional share issuance. When we went public, we had about 2.5 million shares outstanding. After all the various transactions that we've done since, we have 3.8 million shares outstanding. So our market cap has gone up substantially over that time frame, but not so much relative to the price of silver. The A leg shows our revaluation from when we went public and an additional money raise, which was below the IPO price. B shows a transaction closing for another royalty that we've done. C was a restructuring for Gold Mountain, which is one of the royalties, very early royalties that we have. And it's not as relevant today as it was back then. Obviously, as we expanded the portfolio, the impact of it right now is about 10% to revenues, which has been entirely replaced by the price of silver in the last year. Nonetheless, we also had to issue additional equity to close the final tranche of the PPX transaction, which now we have done. And that's where the bottom here between C and D is. As well, we did not participate in the big run up in the price of silver. So again, silver being the denominator here, the C movement is down, and now we're in the process of re-rating, in the process of all the bad news in the market, and now we're just moving forward. I mentioned I find the stock personally to be undervalued. CEO purchased over 20,000 shares in the market since IPO. That's actually 22,000 as of last week. Every one of these gray triangles is myself personally buying the stock. The CFO came in last week and bought a little bit as well, 500 shares. This is all publicly disclosed on SETI. But the reason why we keep doing this is because we find the stock to be inexpensive. We historically have traded between 12 and 20 times sales. Right now, we're about 14 times sales. So on an absolute basis relative to our past performance, we think that there's some upside from here, 50%. But comparing to other royalty companies on this chart on the right, we can see that the sub 1 billion market cap revenue generators in the royalty space on a market cap weighted basis trade around 40 times sales. We're trading at 14. So there is, in our opinion, quite the potential for a re-rate here. And we would expect that to happen again, either as we add another asset over the next few months or as we enter free cash flow in Q2 next year. This is our production profile on the right here. Just shows our historic growth. This averaged more than twofold increase year on year over the last 3 years. We expect to repeat that into next year. And then hopefully it would be my personal goal to keep repeating that going forward. But even if we don't add any other transactions at $48 silver and we're trading at 51 right now, we can defend valuation of between $13.5 and $21. I'm happy to go into other valuation metrics other than just price to sales. But the reason why I pick on price to sales in this particular instance is very few companies have free cash flow that are sub $1 billion market cap. So it's very difficult to use price to cash flow multiples since only 2 companies have free cash flow presently. That's not to say they're not going to have it next year, which we fully expect a number of companies in the space to have free cash flow next year, including us. But even on those metrics, future free cash flows, if we look at numbers that are out there by other analysts, we think that we are relatively inexpensive and there's substantial upside for us from here to the tune of 2 to 3-fold. In terms of capital structure, we have 3.8 million shares outstanding. Founder round was done at $1 and the latest round of financing was done at 5.5. We're trading around $5.56 right now. There are a number of warrants that have been issued with various rounds, and the 8.25 warrant is listed in trading. That's the C class. And the $16 warrant is also listed in trading. That's the A class. The C class warrant is quite liquid. It's pretty easy to pick some up. And if I use option pricing, and I occasionally take a look just out of curiosity, they're actually trading at about a 10-15% discount, the warrant C, the class C warrants, even on the ask. So in terms of ownership by investor type, half retail, almost 15% institutions. We have Europe Pacific. We have US Global as 2 of the institutions. That's publicly disclosed. There's a number of smaller hedge funds in there as well, which are not publicly disclosed, so I don't talk to that. But management, I'm about a third of that pie at 8%. Then obviously I mentioned the CFO purchased some and some of the early co-founders or early directors that put money in at the founder round. They're a part of this group as well. Friends and family, that's obvious. In corporate, that's where we utilize equity in Silver Crown to get silver from operators, so they end up with a portion of Silver Crown royalties. And that's pretty much it. So I'm happy to answer any questions.
Thank you, Peter, for the presentation. And as you said, we'll now move on to the Q&A. So your first question for today is, what realistic size deals would you say are in your realm?
So we are looking at a 5 million, 7 million, 4.5 million. These are all Canadian type deals right now. Again, we don't want to issue equity at this price because we think we're tremendously undervalued. So we're not going to do bigger deals that would require us to issue a substantial number of equities, especially to the public. So, once we're $10, $13, we can do bigger deals. Happy to do that. But until then, until we get that re-rate, it's going to be in that, $4 or $5 million range where we end up utilizing some of the cash that we have on our balance sheet. But also what we end up doing is we utilize some of our equity, but at a higher price than what we're trading.
With free cash flow pegged for mid next year, would an expansion of the team be looked at for the deal finding?
Well, I did mention there's 2,400 deals or 2,400 operating mines that we are aware of. It is a consideration, of course, but it's not the sourcing of deals. It's not the lack of deals. It has been the lack of capital for us. And that's really what's been the hang up here. So no, we do not expect to go on any kind of a spending spree or anything like that. There is a conservative approach that I have. There might be some more spent on marketing. There may be a specialist perhaps in a certain sector where we have no experience, like recycling, for example, that we could tap into, but there's nothing concrete at this point. And of course, with the way that we generally tend to approach G&A expense, a lot of it would be motivational based or success based in terms of, okay, if you perform, here's the payout. If you don't, there's the door. That essential approach.
Is there a target leverage ratio, or do you intend to remain fully debt-free as the business scales?
Right now, we believe that our cost of capital is more than 13%, especially if we look at PNAV multiple for our own company. We're probably 0.3 times NAV. So on an equity cost of capital basis, looking at debt makes sense. If we can get debt at 13%, that's not illogical. When it does become illogical is when our equity cost of capital is less than what the cost of debt is. So if we're trading at NAV or a premium to NAV, then our cost of capital is less than 5%. And at that point, taking on debt makes absolutely no sense at all, because why give that extra interest payment to a debt or to a lender as opposed to, capture the spread for our investors? So under some circumstances, yes, if we remain trading at 0.3 times NAV, we will definitely consider lines of credit. But another aspect to that is the only time that we will ever draw on a line of credit, even if we do have one established, is if we have enough free cash flow to support fully whatever we draw down from that free cash flow. Not from any future deals, not from any anticipated anything. From historic free cash flow, can we support this drawdown? If yes, then we'll consider it. And again, it has to be competitively priced in terms of cost of equity capital, cost of debt.
If silver investment demand levels off, what price level does industrial demand support?
Personally, because silver is such a small component of pretty much everything that it goes into, it's only consequential because of the number of things that it goes into. But because there are other things that go into that exact same thing, nobody's going to stop making cell phones because silver went to $1,000 an ounce. They would probably substitute for gold for silver at that point, but obviously that's upside down right now. So substitution can occur at some future price point, but it's certainly not going to be at $50 an ounce. Otherwise, we would have already seen that. Also, there are certain things like photovoltaic features that silver has that no other element has. And this is where the photons from the sun actually create energy from activating electrons in the atoms of silver. This only happens with silver. I'm not a chemist, I'm not a physicist, I don't know why this is exactly, but there's really no substitution for that in photovoltaic cells. On the flip side, in terms of production, again, because silver is 80% byproduct, the silver price move would have to be very substantial in order for somebody at a copper mine to say, oh, we can now make more money from silver. That's been 1%, 0.5%, a 1/3% of revenues for the last 50 years. All of a sudden, it's a major component. Okay, let's refocus. Let's put more of this stuff out there. Let's make more concentrates because silver price went up. So, from those two angles, I really don't think that there's any threat from either side. And I don't want to sound dismissive here. I've given this quite a lot of thought, but there is, very inelastic response from both sides, the demand and supply, and especially from the supply. So if silver prices level off here, I don't think anything changes over time. What you would need to see happen to get more silver out there is higher metal prices from other places like gold, copper, etc. Gold's an interesting one because now we have to look at what gold actually is relative to other metals. But copper right now, if you look at copper in terms of gold, it's trading at 20-year lows. It peaked out in 2004 and it's trading at 25% of that. So there's not going to be that much of a drive to increase copper production. And then we can go into how long it takes to put new production online, etc. So I think that silver price is fundamentally around $50, no problem. And from the credit creation side, which in my opinion will never stop, you simply have 10% rate of increase for the price in dollar terms of silver going forward as far as the eye can see.
Are you aware of any potential throughput expansions within your asset base that could materially lift royalty revenues?
Well, yes. So the first and foremost is PPX, who is right now putting a mill on their property. They're building it out. They're very good at providing news updates on this, so I would recommend looking at the PPX website and their press releases. They're targeting the end of this year for completion, early next year for commissioning of the mill that they're putting on site. And that's a step function. That ends up, for us, we're somewhere in the neighborhood of about 3,000, 4,000 silver ounces a year. That's going to go to over 50,000 ounces a year. So about a 10, 15-fold type increase in terms of production. So that goes for, this is a primarily gold mine, gold, silver, but that also means that obviously that gold production is going to increase by that amount. So that's one. The other one is Pilar, and Pilar has been in a restart kind of phase for some time, but now with new management, with recapitalization, they are tracking somewhere at the end of this quarter, early next quarter for a restart, and they may be able to, from the gold production that they have not only in stockpiles right now in front of the mill, broken or underground, etc., but they may be able to generate enough revenues at a low enough cost to be able to fund additional infrastructure development, by which I mean underground development, getting more equipment, which was always the bottleneck, and feeding the mill. Now, this is a substantial size mill at 4,500 tons a day. We're basing our initial transaction on 2,500 tons a day. So there could be upside there as well. Would that happen immediately? No. It would take probably 12 to 16 months, but that's another potential increase. The other royalties that we have, they're not producing right now. One of them is being developed, so that depends on when the financing and development take place there. The other one is Scotia mine, which is in Nova Scotia, obviously, and that's whenever that restarts, whatever it is, 07, 08, that's when, 27, 28, that's when we would expect to see revenues from there. But the two substantial shifts, the highest probability is at PPX, of course, we're expecting that, and at Pilar.
Are we putting the cart in front of the horse to assume a dividend in Q2 or Q3 2026?
Well, it is my own personal full intention to be paying a dividend, because ultimately my pay structure is based on a dividend. So from a greedy, selfish perspective, that's exactly what I would like to see. And the company in its entire basis is being set up to be a yield product. Well, if you're not paying a dividend, you're not a yield product. The next extension of that will be, well, that's great. So you're paying out all your free cash flow and dividends. How do you grow? Well, the growth will be through utilizing our paper to bolt on additional assets. So yes, there will be future dilution, but that's why we only have 3.8 million shares out. Now, there are very specific metrics I could get into, but I'll go at it from the other side. If we were to grow to a 5 million ounce a year silver royalty company, it would cost us $500 million, which is another 100 million shares at this price. But $100 million at that revenue line, and you can apply other metrics, that's a 5 billion, 7 billion market cap company. So you're looking at $50 a share. So if you're doing accretive deals, the share price should go up despite dilution. If you're doing destructive deals in terms of IRR being less than your cost of capital, then your share price will go down.
Is there a country that has more private recyclers or mining alternative options to focus in on?
You know what? It's mostly the Western world, really. So we're looking at Europe, we're looking at North America predominantly. There are other places, obviously, that are stepping up in terms of recycling. Mostly it's in metropolitan areas. It's going to be places that have offices and things like this. So, obviously all over South America, you have big places like that. But the focus really will be on first world. It will be Canada, it will be United States, and then later it will be Europe, because there are just so many opportunities. There really is no need to establish these relationships that you need to have in foreign jurisdictions in order to be able to do the right deal with a private entity, private enterprise. I would argue it's difficult anywhere, but probably a little bit easier, especially if you speak the language and there's a rule of law that's been around for a while and you're familiar with it because you've lived in those countries. So sticking to Canada, US would be the predominant focus for us for the time being.
How do you source your deals mainly? Is there a database of small silver production from metal producers?
So the way that we source our deals when it comes to mining is, yes, there's a database that has producing mines, that has projects, that has all that stuff. What we've done, because we, again, wanted to not have one single source of all of our revenues and just be dependent on one project, because we've seen other companies falter because of that approach. We wanted to build a portfolio of small little blocks that get bigger as we get bigger. So we rank those producers from smallest to largest. Now, understanding that if you produce copper, if you produce gold, you're also producing silver, we didn't just hone in on silver mines. In fact, very much the opposite. We honed in on mines that produce silver that really don't care economically about it. They still get a couple of dollars per ounce of gold in terms of reducing their operating costs. But, if your operating cost is $2,000 an ounce and your silver contribution is $10, you're okay to part with that. So these were the types of royalties that we focused in on. And in fact, so far to date, of the 5 that we've closed on, not a single one of them is on a primary silver producer. And every time you produce gold and every time you produce copper, there will be silver in the mix. So we didn't have to filter for silver at all. We simply said, are you producing, yes or no? And in terms of size, we just ranked them from the smallest in terms of tons per day processed to the largest. So, everything from at that point in time, Gold Mountain was right there at the bottom of the list. There was a couple of panhandling things in West Africa we didn't go after, but all the way down to Chiquicamata, you will have, there's your 2,400 mines ranked from smallest to largest. And obviously the smallest ones will produce less silver than the bigger ones. And we just go through them, we make the calls, we make the introductions, and we see if there's a transaction to be had.
With being such a niche, who would you consider as your closest peer, and how does your valuation compare?
The 2 closest peers that I would consider would be ones that have a similar feature in terms of the drive and the focus, or by coincidence, is what they have is operating cash flow or free cash flow, depending on how much of that gets spent, and dividend payments. So there's really only 2 comparables in the sub-billion market cap space, and that's Vox Royalty and Sailfish. Now, these are substantially larger companies than us in terms of market cap. But in terms of where they trade on a price to cash flow or on a dividend yield basis, again, that would speak to our relative inexpensive status. But again, this is something that's, the market will require proof that, we're on the path there, we are generating free cash, whatever, then you get your re-rate. Or we add an asset between now and then, get the re-rate sooner. But those would be the 2. I mean, the sub-billion market cap and smaller space, it's quite populated, mostly with precious metals, mostly with gold royalty companies. But there are some that focus on lithium as well. There's an electric company there, or called Electric Royalties. That one focuses more on lithium, copper, those sorts of metals. And I tried to filter out the iron ore producers, of course.
Have you seen any inbound inquiries to date?
In terms of producers or operators looking for help, yes, we have. And in fact, coincidentally, that's one of those inbounds was a transaction that we didn't close because the ask was too high. We simply said, hey, listen, the returns that your transaction proposes are significantly below our cost of capital. We can't help you.
How has the minimum delivery payment structure performed when making royalty contracts? And what challenges or lessons have you encountered?
It's actually been quite received. The only pushback that we have, obviously, is there's a key understanding that has to be made first and foremost, and this is the minimum deliveries are not actual physical deliveries. These are payments based on production numbers or minimum production numbers. So no physical metal actually lands in a concentrator that we own, because it's the only type of product that a mine produces. Even if there's a gold room, it still produces a dory bar that goes to a refiner. So if we wanted to get physical delivery, they would have to go into the market and buy the metal themselves. Instead of doing that, we simply take the cash on settlement, and with that cash, if we so choose, we buy physical. And we have done this. We have used PPX's royalty payment from Q1 this year to purchase a number of ounces, and we've done that in subsequent payments. So some of our cash is in silver. So that's the first thing that kind of has to get around. The other one, of course, is the producer, the operator has to be comfortable that they can meet these minimum levels. And how we establish those is by working with them, seeing what the historic relationship between the silver and gold has been, the payments from the smelters or from the refiners or wherever that settles, and see, okay, is the ratio 3-to-1, 0.3-to-1, 1-to-1? What's the low water mark over the last 10, 15 years that you got delivered. Okay, let's take another haircut on that. Are you comfortable with delivering at least that? Because the last thing we would want is for the operator to go and take revenues from the primary metal to settle the minimum deliveries. And also because silver itself is such a small component to a gold mine, for instance. But the other thing, if it's a bigger component, we internally say, okay, we won't take more than 5% of revenues. In fact, we've never done more than 2% so far, 2% of revenues. So it's a very small component of the overall revenue structure. So hopefully, even with price fluctuations, whatever, the company will always be able to meet that, and it's very friendly. As well, if there's any kind of a delay in payment, we work with the operator to obviously recoup that. And while that is happening, there is a interest payment being charged on that, which is not, in any way usury or whatever. It's LIBOR plus, but it's very close to what our cost of capital is. So very friendly terms, in other words.
How do you see the deal landscape moving forward?
Again, there's a lot of projects to go through, a lot of projects to look at. I think that our hit rate in terms of how many we've looked at and how many we've actually closed would be somewhere in the 5 to 10% range. So, if there's 2,400 mines, I'm not saying that we're going to approach all of them. That's impossible in a human lifetime. But, the pipeline certainly is full as far as the eye can see. And what I'd like to get back to is my own personal goal, which is to double the silver ounces on a year-on-year basis. And I think that's entirely doable based on just the projects that we're aware of out there.
Thank you so much, Peter. So that wraps up your question and answer session for today. If you did not get a chance to submit your question today, you can reach out to the appropriate account manager here at Renmark. That concludes our presentation for today. But before we go, I will turn it back to Peter for final remarks.
If you have any other questions, if you have any additional need to chat, I can be reached through silvercrownroyalties.com. There's additional information there, and there's contact information there as well. Thank you.
Thank you to everyone in Calgary and surrounding areas for joining us today. Once again, this was Silver Crown Royalties trading on the CBOE under the ticker symbol SCRI and on the OTCQX under the ticker symbol SLCRF. Stay tuned for other presentations in your area and see you next time.